Hi everyone, welcome to another Maine SBDC webinar. My name is Kelsey Brearden and I am here to facilitate this webinar on understanding and repairing your credit with Maine SBDC at NMDC, which is Northern Maine Development Center. Center Director, double center is like TGIF. Business advisor Brandon McDonald is going to be leading us through this credit explanation, and he's going to give some tips for being proactive as well as reactive. So it'll be helpful to get you all your ducks in a row as businesses are getting started, or if you're a little ways in and trying to consolidate things. Go ahead and utilize the chat feature to submit any questions you have. We'll definitely have time at the end to go over anything that is not covered along the way. But also feel free to introduce yourself in the chat. Let us know where you're zooming in from, maybe what business industry you're in, or if you have a business you'd like to share with us, you can pop your website in there. And you will also receive another follow-up email from me after this that will include a recording to today's session. So if you want to go back and double check anything or you miss anything, you can always review that. So that email will include a link to the recording as well as the slides and any other resources we may mention. So keep an eye out for that. Otherwise, I will pass it over to Brandon.
Thanks, Kelsey. Yeah, as noted, this is going to be kind of a brief synopsis of how to understand credit, how to repair some credit issues that you might be encountering. I do have it in the bottom. Let me see if I can get it. There we go. So this advice, it's not meant to replace that of an attorney. I'm not licensed to practice law, and contrary to popular belief, I do not play a lawyer on television. I'm sorry for anyone who thought otherwise. So again, if you have a question that should be more geared towards a lawyer, specifics like should I go through debt settlement, should I go through bankruptcy, we can provide just basic feedback, basic overviews of what that is, but anything that involves a true to life legal question, please work with a lawyer to figure out if it's best for you. Going forward, so here's going to be a basic outline of today's webinar. So we're going to have, we're going to go over some lines of credit, different types of credit that you can obtain, some key lender terms, and it's just going to be a couple. It's already overwhelming enough, and I really don't want to overwhelm beyond that. So if there's a term you'd like beyond those, please feel free to drop it in the chat, and we'll try to get to it. Prioritizing debts, so understanding what debts should take priority, especially during an economic downturn like the one that we're in right now. Options for credit repair, so it's going to go anywhere from basics to more extreme levels of credit repair. And then understanding alternative lenders, because when a bank tells you no, it's not necessarily the end of your search for maybe a loan or some credit. So to begin, here's some lines of credit. And again, there are some specialty lines outside of this. So there's your revolving unsecured line of credit. So that's going to be your credit cards, maybe a store card. It's normally going to be unsecured, which means there's nothing backing that line of credit. So if you were to stop paying the bank, essentially, other than their ability to go after you as an individual, they don't have anything that they could secure that debt with. So it's a lot harder for them to collect a debt without going to court and getting a judgment, which is a financially difficult and a long, arduous process. So the caveat there is that essentially a unsecured revolving line of credit has a higher interest than secured debt. So on the alternative, there's a revolving secured line. So this is something maybe a local lender would offer, maybe a larger lender would offer lines of credit that are secured. And it's got some kind of security agreement in place, something like real estate. So your business, your home, your vehicles, maybe cash assets, maybe some kind of security interest that the bank can say, yep, that's definitely something that I'm able to repossess in the event of you not paying. I feel a lot more confident giving you a lower interest rate. So it's not uncommon to see a secured credit line, especially a secured line of credit at maybe a 50 to 75% reduction in interest compared to that unsecured line. And so then you go into term loans. And so an unsecured term, that's going to be a loan with a higher interest rate. So sometimes you can see banks call these a personal loan, but really it's kind of got that same stigma as a payday loan. I put payday loan in red because you should just never get one. Don't even think about it. Forget that term after we're done today. Don't even consider a payday loan. Payday loans just have unrealistic amounts of interest. Most states have barred the use of them. Or cap the interest rates. So getting around it by calling it a personal loan, you can still end up seeing interest rates as high as 25, 30%, even from the most reputable lenders. So that's just something to keep an eye on. If you're going to get an unsecured term loan, make sure the interest rate is not unbearably high. And so again, on the flip side, you're going to have your secured term loans. So a bank is going to have security interest similar to that revolving loan. You're going to end up, giving something up as a security agreement to the lender, and it's going to be a lower interest loan than if it was an unsecured term. Most of the time, you're going to go for a business or a home loan. It's going to be a secured loan. It's just really hard to get outside of a business loan, especially one in the $25,000 to $30,000 mark. That's usually kind of the hard cap. Some lenders will work with individuals who maybe you need a $40,000 secured loan and you have a great credit history and you have good co-signers and maybe you're willing to put up a vehicle. Maybe there's a way to get in there without tapping into your home's equity or your business's equity. But most of the time when you go in and expect a larger term loan, expect that you're going to have to put up some kind of collateral in the form of usually real estate. So here's a lot of terms. I'm going to try to go through them as simple as I can, but not take too much time on them. So these are terms you're going to probably hear when you go to get a loan, when you work with a bank or an economic development lender. So the big one normally comes out to collateral. So collateral is a security interest that's going to be taken by a lender in order to secure a loan. And so if you go in with $100,000 of equity in your home, or $100,000 of value, that's the full value of your home. Actually, a lot of lenders, they rarely will loan on that entire amount. So you'll have a collateral gap. They'll say, well, it's worth $100,000. We can give you 90. We could give you 75 or 80. It depends on their internal procedures on how they collateralize a loan. But essentially, it all comes out to the fact that if a lender has to put up a piece of collateral on an auction, on a foreclosure sale, they're going to get less than the actual value of the loan. So essentially, as disheartening as it is to hear that your piece of equipment or your inventory or whatever is not going to be taken at the full guaranteed value, it's just important to remember that if the bank has to repossess, the bank loses as well, typically. And even at 90%, historically, when my organization my host organization has had to repossess, they'll get anywhere from 70, 65% of the actual value of the real estate. So even at 90%, typically a bank will lose when that goes to a foreclosure or a repossession sale. So a couple of the other collateral pieces, sometimes they'll give 75% of a new piece of equipment. So if you're buying a new truck, they may give 75% of it. 50% of used equipment, and rarely a lender can take inventory. But the problem with collateralizing inventory is lenders like to say it walks away. It's something that it's really hard to give an accurate present value of because it's always moving. Your inventory isn't expected to be a long-term asset, but rarely, if there is a collateral gap, sometimes a lender can take a look at that. So then you have loan guarantees, and that's typically a state or a federal cosigner at the end of the day that promises they'll pay your loan in the event of a default. That doesn't keep you off the hook. It just makes you more of an appetizing risk to a lender. So it's something that if a lender believes that you're a high risk, they may introduce you into a guarantee program, and we'll talk about that a little bit later. So then you have your APR. That's going to be your annual percentage rate. It's known as interest. These could be a fixed or variable rates. And right now we're in a a low prime rate market, a variable interest rate is going to vary depending on that prime rate. So be cautious of taking out a variable loan when prime rates are this low. Essentially, what's going to happen is the floor is so low and the ceiling can get so high from here that essentially you could balloon into something. You get in today at 4%, and then tomorrow it could go up to 15, 16 if the prime rate goes up drastically. So keep in mind that a variable rate is good in times where the prime rate is high and it really only has room to drop. And when it's the other way around, it's just not as favorable of a loan to get into. So then we look at deferments. And so sometimes these are called moratoriums, deferments. It's just essentially a period of time where loan payments are halted. Interest will typically accrue during these periods of time. Essentially, it's you're struggling. You need to figure out if there's a way for you to hold off some loan payments. A lot of lenders offer some kind of deferment, moratorium program. It's really good to ask a lender and say, listen, what options are available to me? I'm struggling right now. COVID has brought out a lot of deferment programs for individuals who have loans, whether they're new loans or existing loans. So it's always good to speak to the lender. And also kind of going off a deferment is the grace period. So the grace period is a period where both your interest and principal are not charged to a loan. It's very rare. It's used typically by economic development lenders or maybe a community's revolving loan fund. So let's say I'm starting a restaurant. Maybe it's a seasonal restaurant, but I want to get it going now. Sometimes a small lender who's more out for the borrower than themselves, they're going to say, we may be able to offer you a grace period on our portion of the loan. So it's something that's rare, but when it's offered, it's very welcomed. So then you're going to have things like your prepayment penalties. These are getting more rare as time goes on. Essentially, it's a bank is going to ask you to give back. You know, if you're going to pay off your loan early, the bank loses money, essentially. Even though at the end of the day, you've paid them interest, the bank still views it as a loss to them. They were expecting you to pay that interest out. So they may charge you a penalty for paying your loan up front, trying to get, away from that interest over time as quickly as possible. So keep that in mind that there's sometimes are prepayment penalties on some loans, some secured lines. And it's important to understand, is there going to be a prepayment penalty associated with my specific loan? And then finally, this is more of a closing term. So when you're closing a loan, sometimes there's going to be an appraisal ordered. An appraisal essentially tells a lender, this is the value of a property. So sometimes they can go by the tax assessed value, although for many of us who own homes, we know that the tax assessed value and what we paid for the property can probably be a little different. So the appraisal tells the bank, this is the value of the home, the real estate, the piece of business property. So typically a commercial appraisal, it varies because most of the time it's someone traveling out of the way. Those of you who live in Southern Maine, you probably have a lot more appraisers than us in Northern Maine. Sometimes we have to hire out of Bangor all the way up in Aroostook County. So when we order an appraisal, it can be anywhere from the $2,000 to $3,000 mark. But again, in Southern Maine, it could be a little bit less. And typically the appraisal is going to be the responsibility of the borrower. And because of that, sometimes a lender will say, oh, don't worry about it. And they'll lump it into the actual loan cost or the loan proceeds. So you'll pay that appraisal cost either upfront or over time with the loan. So keep that in mind. So I did a little bit of a chart on the cost of credit. So here's the beginning of it. So on the left, you're going to see interest rates. So the interest rates are going to vary from anywhere between, I think it was 2% all the way up to about 16% for a 350 credit score, which I should probably note, if you have anything less than a 550, it is going to be very, very, very difficult for you to obtain a loan, even on a secured credit line. What's going to happen is it's just going to be more advantageous for you to find a cosigner, put up a lot of security interest, and then attempt to work with a lender through that, but you'll probably still get a ridiculously inflated interest rate. So this interest rate is actually going to be based on a 10-year, $100,000 secured loan. And so the next slide is going to explain what you're going to pay over time for the interest on that $100,000 loan. So if you're an 850, if you're, nearly perfect for a credit score, you're going to pay roughly $116,000 for that $100,000 loan. So you're going to pay about $16,000 in interest. And as your credit score drops, you're going to pay exponentially more. So that 350 or the 16% interest rate, which could be assessed to a 550 depending on how the climate is, how the borrowing climate is, you could be paying about $100,000. Even if you pay on time, you do great. It's a secured loan. The bank is very safe. You're still paying $100,000 on that loan because of the interest. It's ridiculous. It's something that you should definitely be cognizant of. The difference, again, just in a 10% interest rate can be nearly $70,000, $80,000. So it's really important to understand what your credit score is at, understand how you can fix your credit score. And we'll go through a couple of methods in here, but really the best way to keep your credit score going is to have out a few lines of credit that you pay on constantly. You don't have to hold balances on them. Some people will put on $100 over 6 months. They'll every 6 months they'll put on $100 on a card just to keep it open. And that's fine. That keeps your credit history going. It makes sure that lenders can say, oh yeah, that person, definitely pays their debt. It's important because a lot of people are like, I'm a 550, but I've never done anything wrong. Well, technically, you probably haven't done anything right either. You have to show the bank that you have taken out a line of credit and that you can pay on it. So just because you don't have credit doesn't mean you necessarily have good credit. So we'll go on a little bit to prioritizing debts, and going off of how we said you can keep your credit strong, prioritizing debts probably isn't going to keep it strong, but it's something we have to do during an economic downturn. We have to sit down and say, what is the priority to us? And some of this may differ. Some of us may say, family and friends, I can't look my mom in the face if I don't give her back that $100. She is my number one, and the banks and everything else can wait. And that's okay as long as you understand the consequences that could come from debt prioritization. So to begin, you should worry about yourself, your self-sustenance. That's things like your rent, your utilities, keeping on the lights, keeping food on your table, ensuring that you can wake up tomorrow and feel confident in turning your business around or turning your situation around. So make sure you prioritize that bare minimum for yourself. Then you're going to move on to your secured debt. So these are the things where if you get behind too much, there's a chance that a bank could come in and foreclose on a home, foreclose on the business. Essentially, prioritizing just means that's when you're going to contact the lender and you're going to say, listen, I'm having some issues. What exists for deferment? What exists for forbearance? What options do you have available so I can get out of this and pay you? Because at the end of the day, even on a secured loan, banks don't want to foreclose on a $100,000 property and take that $60,000, $70,000. They really want you to stay in there and pay that $150,000. So if they can help you get through a really difficult time, most of the time they will help you get there. And there are some agencies that negotiate on your behalf to do this. I suggest to stay away from them unless it's a trusted attorney that you use that's doing it. The organizations, they normally will charge you based on the savings that you'll get through them. So if they make it so you get into a plan where you pay less, usually they'll cut a fee to themselves into that agreement. You'll pay them 10, 20, 30% of whatever the bargained agreement is going to be, the monthly cost, and they charge that as almost a administration fee to have helped you. So it's something that stays with the life of the loan. So that's why I say when someone's saying, oh, well, I heard this on TV, they can help me with my debt or helping me, negotiate with a lender, just be cognizant of the fact that you're probably going to be charged monthly, and it's not going to be a one-time, you meet with the individual, they negotiate, and it's done. It's usually that long-term administrative cost. So then prioritizing, you're going to look at your unsecured loans, your credit cards. These are things that, if you miss some payments, it's going to ding your credit score hard. But nonetheless, it's going to be more important for you to worry about secured debts. An unsecured debt can take you to court. So an unsecured lender, they still can take you to court. As I said, initially, it's a longer, arduous process. Sometimes they can go through small claims court if the amount is small enough. But again, it takes a long time And some lenders just say it's just not worth it for that small of a debt. Others will sell it off to a collection agency, and at that point, it's up to the collections agency on if they want to settle, which we'll talk about a little further on, or if they want to take that debt to court. And then at the end, I like to say a family member, if the family member is doing well, if you know that they don't absolutely need the money right now, be communicative with them. Make sure you communicate and say, maybe I'm going through a rough patch right now. I just need to prioritize what's going on, and you will get paid. Sometimes that's all it takes. But again, some people put family and friends even above self-sustenance, because at the end of the day, I can't look my mother in the face if I can't pay her. So here's a couple of the options for credit repair. And so starting from the first one, this is going to be more for individuals who have low credit. They don't necessarily have bad credit. So if your credit is low, if it's average and you want to get up into a better range, you should be diversifying your credit portfolio. So a lender likes to see more than one type of credit, whether that's maybe a student loan. So that's going to be your long-term loan credit. Maybe it's a car loan, a home loan, a personal loan. If you don't have any credit cards, it's a good time to take one out and not use it. Use it again, maybe once every couple of months. And that way you pay it off and a lender says, oh, this individual has great credit because they've been paying as agreed. They've got a history that's built up over a year, 2 years, and they've had no problems. A credit card doesn't necessarily mean that you need to keep a balance on it through the year. But just remember that if you don't put a balance on it every couple of months, the credit issuer has the right to close down the account for non-use. So if you are going to take out a credit card, if you've never had one before, if you don't have more than one, it's a good opportunity to take out one just to build up that credit. If you have too much in debt, so let's say you've taken out 5 credit cards, they all have different sporadic interest payments. Maybe consolidation is an option for you. So debt consolidation is something where you work with one lender. You say, I have $10,000 spread out through several credit cards, and they range from 10 to 18% in interest. And you get them consolidated into one loan, you pay them off, you take care of those credit cards through a period of time, and then you build into a better credit system. So you want to make sure that instead of 5 cards that you're struggling to pay on, maybe you're not making the minimum payments and those are dinging you once or twice a year. You instead consolidate, pay those off, and then take out a more manageable amount of debt. So take out 1 or 2 cards. If you can, try to keep it so you're not keeping a balance on them, because that's going to be where that compound interest comes in, where you're constantly keeping a balance on your cards. You're paying on that balance over and over and over. Most credit cards have a grace period, so I think it's actually federally mandated, but I might be incorrect. So you have up to 30 days from the date the balance was 0 to put charges on the card and then pay them off, and there will be no interest assessed to that. So as long as it's that grace period, and you'll be able to tell from your statement, you're going to get a statement either electronically or in the mail. You'll be able to tell if interest is accruing on that credit card, and if not, it's fine to use the credit card for purchases that you're already going to use your debit card for, and then pay them off. So as things get a little bit worse, maybe you need to work with a lender. So a lender is going to have some options available to help with your issues that come up. That's going to be where your moratoriums, your deferments, maybe some kind of grace period if your lender is very, very kind. The SBA, so for anyone who had a small business administration microloan, they were given kind of a default grace period where they had to make no payments on their loan, and the lender actually made 6 payments on their behalf to the both principal and interest of the loan. And this was last year due to the COVID pandemic. So essentially, some of these programs are very, very good for the borrower, and maybe you don't know about them. So if you're struggling right now, it doesn't hurt to give your lender a call and say, I'm just wondering what kind of options are available for any kind of debt relief through my loan. And as things get worse, so you're going to end up looking at debt settlement. So this is where maybe a collector, maybe the bank is coming after you and they're saying, hey, you owe $10,000. But maybe we're willing to take less if you're able to offer it up front as an upfront settlement. So doing this on your credit report will report it as a paid as agreed or paid as settled note. So that doesn't mean that you're going to get the same credit boost as paying in full. That's going to be the difference. Some individuals can work with a lawyer, and that lawyer may be able to negotiate both a settlement and a notation on the credit report for paid in full. Understanding the difference between those two sometimes helps people understand how it's going to play out on your credit. Another thing is that debt settlement has some tax implications associated with it. It's important to talk to an accountant to understand those, because essentially there is the opportunity for any forgiven proceeds. So that's going to be whatever was the difference between your settled amount and the actual value of the debt. That could be counted as income for you. So it's important to understand and maybe talk to an accountant and say, listen, am I going to get hit into a different tax bracket because I'm going to have this forgiven loan balance put as an asset, essentially, as this income. So keep that in mind if you're looking at debt settlement. Another option, and this is one of the extremes, it's the waited out option. If you're already 4 or 5 years into a debt that you've been worried about, if you haven't been sued for it, doesn't mean it may not happen, but the Maine debt statute of limitations is 6 years from the last late payment date. So again, we don't give out legal advice, but the actual definition in the Maine state statute is a credit card, a credit issuer. They have 6 years, and this is mostly going to be for unsecured debts. They have 6 years to sue you from the last date that you were late on a payment. And for the purposes of your credit report, that should fall off your credit report in 7 years. Doesn't always, so you may have to do some work on your own side to work with the 3 major credit bureaus to resolve anything that was definitely gone or definitely should be off your report in that 7 years. On the secured world, it really depends how a lender writes out their contract, but essentially they have the right to go after anything they have a security interest in, probably at any point in time, depending on how their contract is written. So that's something you're going to want to talk to a lawyer about to determine if that statute of limitations would apply to you if you're a secured loan. And this is the end of the line. So there is bankruptcy, and bankruptcy is that last-ditch effort for the most severe cases. It can hang around for 7 to 9 years, and most can get a new loan in 3 to 4 years. So essentially what happens is a bankruptcy will wipe your slate clean. You're going to start from the beginning with a big bankruptcy derogatory mark on your credit report. And essentially what can happen is in 3 to 4 years, a lender is going to get more comfortable saying, oh yeah, we'll give you a secured card, a secured loan, maybe even an unsecured loan with a cosigner. So there's an opportunity to go through bankruptcy and emerge out in a couple of years with the ability to get a loan going forward. So keep that in mind if you're looking at a long-term plan for a significant amount of debt. So then we talk about, if a bank tells you no, what options do you have on the alternative? And so there's 4 big options that I've outlined, but again, there's smaller options all over the state. There's angel investors that we didn't even get into that don't even look at collateral or credit, but more of the idea of the business. So to begin, there's economic development. So that's an organization with a specific goal to assist Maine with business lending, whether that's offering a loan directly, offering some kind of technical assistance with a lender that they work with. So I put down a couple of options on the bottom of all of these. These are, some of them are regional, some of them are statewide. And if it's a logo that looks familiar to you, then I would suggest to contact them to determine if there's an opportunity for you going forward. Or on the alternative, you can work with an SBDC advisor, and most of us know the regional alternative lenders to get you in touch with. So there's also regional loan funds. So this is where a municipality, a county, a town, a city, they have a revolving loan fund available. Sometimes they need some significant match, and match just means another lender coming in with them to either spread risk or because their loan funds cap at a certain amount so they can spread as much to as many businesses as possible. They're a great alternative to banks if you are already a lendable individual where you have some security. They're not as heavy hitting on credit. And at the end of the day, I see regional loan funds as maybe the cheapest money available. I've seen them as low as 1% and 2% for a business, which is just really hard for most traditional loans to match. So if you have a development fund available, I'd suggest to look into it to see if that's something that would benefit your business. And so then there's the CDFI, which is a community development financial institution. So these loans usually have good interest rates. They're open to more high-risk clients. They have a goal of lending to individuals who are in economically disadvantaged situations or communities. They prioritize individuals who may have issues getting to a traditional bank and accessing, normal funding. And it's a great idea to work with them to understand what they have available in their portfolio. Some of them have actual CDFI funds that they loan out, and those are, again, to individuals that are economically disadvantaged. And most of the time, they're at a very good interest rate. You can see them go anywhere from a 4 to a 7 or 8 interest rate, depending on the situation. So it's a good time to work with a CDFI or any economic development individual to figure out what those opportunities are. And so then there are your guaranteed loans. And so a guarantee is not to you, the borrower, but it's the lender that's going to get a guarantee. Call it this warm and cuddly hug for the bank. So the bank feels a lot more comfortable when someone backs your loan. So it's almost like that cosigner effect. FAME, which is Finance Authority of Maine, SBA, which is a Small Business Administration, they put out loan guarantees. And those guarantees essentially mean that on behalf of you, maybe they will guarantee a portion of the loan. If something goes wrong, they're able to take a chunk or take a full guarantee, which means they'd be able to pay back the borrower, but you're still on the hook for the loan. So at the end of the day, if you don't pay that loan, even though it's guaranteed, the only person who really wins in that situation is the lender. The borrower still has to take care of any proceeds or outstanding issues that come with that loan. So we're going to end it now. If you had any questions, if you had any terms that you wanted answered, feel free to put them in the chat. If there was anything you were looking to gain from this specifically, again, we don't want to go too much in the realm of legal questions, but some basic guidance I'd be happy to offer. And I will turn it over to Kelsey if there is anything else in the chat right now.
Not yet. So now would be a great time for everybody to rush over there and get your question in first. So thank you so much, Brandon. I feel like I learned a lot. I feel like I learned things in these webinars, so I assume that other people are as well. I'm a pseudo business owner. So I appreciate your expertise in these manners and all of your disclaimers as well. Jennifer is curious about grants. Jennifer, could you clarify a little bit more? You're welcome to unmute yourself.
Sure.
We're a pretty small group. Feel free to explain more in detail. Yes, no, Jennifer? In the meantime, everyone should feel free to submit any questions or was there a new grant coming out?
Jennifer, I'd have to know what kind of grant you were looking at. There's so many sitting around right now. A lot of them are mostly for an existing business rather than a new business. We have one through the SBDC that is going to be announced in probably a couple of months, but that's really not something that we finalized at this point.
I have a quick question.
Go ahead, Amber.
Sure.
As a restaurant, last year my business kind of really plummeted. I took a really substantial loss, and I had to temporarily close down. So a lot of my vendors I owe quite a bit to, and when I made arrangements with them, I had to become a personal guarantee. And so now the debt is not only on my business, but it's on my personal. So I'm trying to figure out ways to get funding, but my credit score is so low because I had no revenue coming in to even make arrangements. And I'm just wondering what would probably be the best opportunity for a small business restaurant like myself to get back into. I know that probably doing a personal bankruptcy and not including my business but the same thing would probably happen. They're probably going to ask for a personal guarantee and run my social security number, right? Don't most banks do that?
Yeah, what's likely going to happen is if you go through a personal bankruptcy, Amber, how is your business structured? Are you a separate LLC from yourself?
It's an LLC and it's an S corp.
Okay, so you'll likely be separate than yourself. So you're correct. A bank is going to look at the LLC, and unless there's a great credit history with the LLC, they're going to probably say, well, listen, you as the owner need to come forward because we're not comfortable giving we're not comfortable assessing this at a high credit risk. So what I would say is likely you'll be asked for some kind of personal guarantee on any kind of LLC credit going forward. And a way to offset that, maybe you could have a co-signer. Sometimes I've seen LLCs use co-owners, rarely, and I would never ask my employees to do this, but rarely. I actually remember a restaurant that went to one of the longtime employees and asked them if they would co-sign. So that may be an opportunity, but at the end of the day, you're correct. If you take something out on a personal bankruptcy, they're going to run your credit. They're going to say, ouch, I don't know if we're ready to work with this business, and that is the only individual whose credit we can pull. What I would suggest, again, it's going to be more debt. You're going to be taking out debt on the business. So the SBA has an EIDL, the Economic Injury Disaster Loan Program. That could be a good opportunity for you, but again, they're going to pull credit if your credit is really, really rough. They may not offer an EIDL to you. If you haven't already, there's several grant opportunities out there that may be able to help you come forward. So whether that's the PPP, that paycheck protection, there might be a little bit of an opportunity there, but it sounds like chances are you're probably going to have to take out some kind of funding to get current on any of those existing liabilities.
Okay. All right. And we haven't heard anything else about the grant for the restaurants relief, right?
I think there was some favorable news that came out over the weekend from the SBA. It sounds like they're going to be piloting. So this did go public. They are going to be piloting a program over the next couple of weeks where they're going to give some priority to different restaurants throughout the country. Just to pilot the system, make sure that everything works. And then my assumption is after they make sure the system works, unlike some of the other grant programs they've been working with, sometimes they go down. Once that system works, they're going to hopefully open it up to the rest of the country. So stay tuned. If you're not already subscribed to Maine SBDC emails or as a client, I would say get subscribed soon because we're going to probably start pounding out some emails on that in the next couple of weeks as more information comes to us from the SBA.
Awesome. All right. Well, thank you guys for this informative info session. Appreciate it.
Sure. Thank you.
Yeah, and I'm definitely going to be sharing all of those updates as they come via social media. So keep an eye on all of our platforms. Caroline is saying that during the pandemic, federal loan holders have been given the option to take a deferred payment profile. By taking advantage of this offer, does it negatively affect our credit scores?
It shouldn't. So most deferments run off a system where they will say agreed as paid or agreed to terms, and they'll report to the credit as either agreed or deferred sometimes. If it's reported as deferred, it should not impact your credit score, although that's something that a lender might look at and say, well, you're coming to me for a brand new credit line, and it says here that your only 4 loans are deferred. Could you explain that situation a little bit more to me? Essentially, it should not negatively impact it unless you're looking to take out new debt with several existing deferred loans. So just by default, the deferment should not ding your credit score in any way as a missed payment or anything like that. So I would definitely say take a deferment far before you start missing payments.
Great. I don't see any other questions, but feel free to plug them in there as we go.
Perfect. I will throw this in here. So If you have any questions, if you prefer to work with an advisor, if you're looking to essentially figure something out one-on-one, you know, the SBDC exists. We don't want to take any law questions away from a lawyer, but we can help you understand what your options are. It's free, confidential. My assumption is some of you are already SBDC clients. Those who aren't, though, feel free to go to mainesbdc.org, click the orange request advising key in the top right corner, and you'll be matched with whoever the regional advisor is in your area. And I hope that you'd be able to get some of the answers that you're looking for, because we're all very knowledgeable on these topics.
And if they don't know the answer, they know who to ask, which is even better. It's a pretty great network. So all of our contact information will be in my follow-up email after this. So that'll probably go out sometime this afternoon. So keep an eye out for that. Like I said, it will have a link to this recording and the slides if there was anything that you wanted to review. But I don't see any other questions coming in, so we can give everyone 20 minutes back to their morning.
Perfect. Thank you all.